Hey everyone, you're in the right place. In this video, we are going to go in depth to learn about index funds and why they are the best investment for most people. And at the end of this video, I'm going to give you my top 5 favorite indexes that you can consider to use in your own investments. Index funds, mutual funds, and ETFs are often words that get used interchangeably. I know it can get very confusing, so by the end of this video, my goal is to help you learn about the advantages and disadvantages of each and to give you more confidence in the subject. Also, if you're new to the subject, please subscribe down below and leave a like. It means a ton to me and really helps me get these videos out there to help others who are too afraid to ask these important questions. So first, let's talk about index funds. Now, you probably already know the most famous ones. When you go to a financial website or watch a financial news channel, you'll almost always see these somewhere on your screen. The Dow Jones Industrial Average, the S&P 500, and the NASDAQ. All three of these are market indexes, and they're used to measure the market and provide important context for investors. Is the market up today or is it down? The Dow Jones is an index of the 30 largest U.S. blue chip companies. They take the price of every stock and divide it by the total number of stocks in the index. This provides a single number that can be used to gauge the general performance of the index. Similarly, the S&P 500 includes 500 large U.S. companies across all financial sectors in the market. Lastly, the NASDAQ, also known as the NASDAQ Composite, covers even more sectors and more stocks with a focus on tech and small cap companies. Now, all three of these indexes are just informational. You can look at any one of them during the day and know whether the market is up, down, or flat. Individual results of stocks can vary considerably. When you hear talk about beating the market, they're usually talking about beating the performance of these index funds. The famous investor Warren Buffett once said that most people are better off investing in the S&P 500 than they are trying to pick individual stocks. That's right. The market that everyone's trying to beat is actually doing a pretty good job by itself. If you had invested $10,000 when Warren Buffett made this comment in 2007, you would now have $52,100, a 420% return. Nice. Now you can't invest directly into an index. However, there are mutual funds and exchange traded funds, otherwise known as ETFs, that you can invest in. These funds hold the same stocks that are in the indexes and very closely mimic their performance. This is honestly why index funds are so great. Markets tend to go up. Now, sometimes maybe not in the short term, but absolutely in the long term. Most of you may not want to be bothered with having to do research and think about which stocks to pick and pay attention to the markets each and every day. Most of us would really benefit from just investing and then forgetting. Well, actually, you should be buying a little bit all the time, and that's called dollar cost averaging, and someone reminded me to make a video about that. There are 3 advantages to investing in an index fund. The first is that it's a passive investment. That means it's something that you just put in and forget about it, rather than something where you're having to research day in and day out, watch the charts, make sure that you're selling if bad news happens. You literally buy it and forget it. The second advantage is that you have reduced risk due to diversification. The market as a whole over the long term tends to trend up. Because these index funds invest in hundreds of companies, you're always going to get that collective movement upwards. If you invest in a small stock, you're going to end up worrying about all the little things. What that CEO said that day, what their particular earnings were. You're going to see dramatic up and downs that may worry you as an investor. The third advantage of an index fund is reduced costs. This is opposed to like a managed fund, where someone is being paid to actually manage the fund, make sure that everything lines up correctly. They go and do the research and buy and sell while you're just a part of the transaction. With index funds, you typically have extremely low costs compared to a more managed fund. Now, there are also disadvantages of investing in an index fund, and that's going to be that while you may be getting your 8 to 10% on average a year, there are certainly individual investments that will outperform this. If If you were to look at this past year in 2023, if you had invested in Nvidia at the beginning of the year, your investment would have grown by several hundred times over, just from that one investment. At the same time, there's probably hundreds of other companies where the exact opposite happened. The second disadvantage is that it's low cost, but not no cost. If you were to invest in a single stock, there's not going to be a management fee. You're the manager. And while that is free for you to be the manager, you're going to deal with that additional stress of watching your own investments, keeping up with the market, and making sure that you're maximizing your profits. A third disadvantage is that sometimes there are investment minimums that are to be met. Not in all cases, but some mutual funds require you to have $1,000 to $3,000 upfront to invest. If you're a small investor, maybe you only have $5, $10, $100 to invest. Some of these aren't going to be good choices for you to start out in. Another disadvantage is that there's no downside protection. If the market goes into recession, you're probably going to carry all that risk downwards, whereas a more active management would be shifting your portfolio holdings into something that's maybe less risky or more prone to going up during a recession. The last disadvantage is that you have no real control over what the portfolio holds. Now, there are indexes where you can pick what you prefer, and we'll go into that in a bit, but overall, once you've picked it, things are going to flow in and flow out, and you're not going to have any control over whether it holds stock in an individual company or not. So let's say that you like the idea that you can invest and then forget about it, and you like the sound of 10% average annual growth per year. Well, how do you invest in an index fund? There are two options: mutual funds and ETFs. I would say that mutual funds and ETFs definitely have more similarities than they do differences, but there are definitely some differences that you need to know. If you're a newer investor and you don't have as much saved up, you might prefer investing in an ETF. There are several ETFs that don't have any investment minimum, so with as little as $1, you can buy fractional shares of an existing ETF. Whereas mutual funds sometimes have larger minimums. In some cases, minimums can be as high as $1,000 to $3,000. However, there are mutual funds that do have $1 minimum investments as well. Another difference between the two is that an ETF can be purchased in real time. The share price of an ETF fluctuates constantly, and you can see it go up and down and know exactly what you're purchasing or what you're selling. Whereas a mutual fund usually calculates its value at the end of the day. If you purchase a mutual fund, you usually won't have that purchase go through till the end of the day. And if you were to sell a mutual fund, you won't actually know what the value of your sale is until the end of the day. When you're talking about a traditional mutual fund, you're usually talking about a fund in which there's an active manager who decides whether or not to sell or to buy certain stocks. And in many cases, you're paying someone a premium to make those types of educated decisions. Now, with what we're talking about with index funds, that's not going to be the case for the mutual fund. They're still just going to try and select the stocks that are within that index. So in both cases of a mutual fund and an index fund, you're going to come across similar management prices. Both mutual funds and ETFs are great options, and each have their pros and cons. I just went over a couple, but what I'm going to do now is throw just a comparison up on the screen real quick. I recommend that if you want to know more, go ahead and pause the video and just read through some of those bullet points. It'll explain a little bit more clearly the difference between the two, and we won't get too bogged down in the details right here. Index funds really are a cheat code, and I feel like the vast majority of people should just do it. Anytime that my friends come and talk to me personally and say, hey, what should I invest in? Or even say, hey, take my money and invest for me, which I always decline. I always recommend index funds. It's so easy. You put it in, you forget about it, and years later you're going to come back to something wonderful. So I highly recommend it. And before this video ends, I'm going to tell you my top 5 favorite index funds. But I also, if there's any questions that you feel that I didn't get to or didn't answer very clearly, please in the comments below, write your question. I'll try and get back to you. If you felt like I did a good job, let me know. But I want to hear from that, and if there's anything, I want to get back to you and help you understand it better. So write that in the comment below. And now my top 5 favorite index funds. These are things that you can invest in right now and be part of this. My number one, and full disclosure, this is what I invest in for my personal Roth IRA. But this is the Charles Schwab SWPPX mutual fund. Now, what this does is it tracks the S&P 500, which I think is perfect. It's got a great history, a great track record. This is a mutual fund with a 0.02 expense ratio. It's important when you're deciding which to buy that you focus on what these expense ratios are, because this is always going to tick away your profits ever so slightly once a year. Now, in this case with Schwab, I'm almost certain that they waived this for me as a Schwab member. I highly recommend Charles Schwab. It's what I've used for over a decade now. A great brokerage, and I believe one of the oldest brokerages, if not the oldest. Highly recommend it, but this is what I put in my personal Roth. I love it. It has a 12.65% annual growth average over the last 10 years. Highly recommend it. This is my number one. Full disclosure, I use it for my Roth IRA, and I recommend all my friends to invest in this one as well. Number two is VU. This is Vanguard's version, another brokerage, their version of an index fund that follows the S&P 500. They have a 0.03 expense ratio for this account. And rather than a mutual fund, this is an ETF, which means that you can buy it at any time during the day. You're going to see it go up, see it go down. It's not something that's going to register at the nighttime. Similarly, and because they follow the exact same thing, it also has a 12.65% average annual return over the last 10 years. You're going to hear about VU a lot if you go on Reddit, if you do any research. A lot of people love it. A lot of people just like Vanguard in general. They have great funds to work with. I personally don't have any, but there's really no reason. They're great, and honestly, I probably should have some Vanguard funds in my portfolio. Number three is a Fidelity account. This is FNILX. This is the Fidelity Zero Large Cap Index. Now, that zero there is particularly important because that means that there's a 0% expense ratio for this managed account. It is a mutual fund with no fees at all regarding the management. And similar to the others, it's a 12.17, just a little bit lower, average annual return over the last 10 years. So if you're looking for zero fees, and like I said, with that Schwab one, pretty sure it gets waived for me. I've never seen a fee on that. But this one, for sure, zero fees. Highly recommend it. That's with Fidelity. Number four is an ETF. It's SDY. This tracks the S&P High Yield Dividend Index. So maybe you're someone who's a little bit older, or maybe you have a lot of wealth already, and you're looking to not have to worry about it, but also get high dividend returns, some fixed income. Highly recommend that for those watchers of this video. I've even started putting some into this because fixed income is extremely important, and the expense ratio is probably the highest among all the top five here at 0.35%. It's important to pay attention to. However, over the last 10 years, had a 9.44% annual return, which is very high, plus you're getting consistent dividend yields from this. So I highly recommend this for someone who's maybe already stored up quite a bit of wealth and is looking now to be a little bit more conservative with their investing. And last, we have another Fidelity account. This is the FSKAX ticker. This tracks the Dow Jones Industrial, so a little different than the S&P. So guys, those are my top five. Highly recommend that you look into those. I think the vast majority of investors should be investing in index funds. It's a no-brainer, and it's an easy way to make money without really having to think about it or work hard. There are way more people trying to beat the market and failing than there are people succeeding. And you're always going to hear about the shoot the moon stories where someone put their life savings into a stock that magically mooned. But for the vast majority of us, that's simply too risky and usually not going to pay off. I highly recommend investing in these index funds. I've given you 5 to choose from. This is not a full endorsement. You make your own investing decisions. However, I think any of those 5 are going to be great opportunities for you. Listen, everyone, if you liked the video, I'd really appreciate you leaving a like, consider subscribing below. I've got a number of other videos on financial topics that you might be too afraid to ask anyone else, but I'm not afraid to answer. So look below, click the like button, and let me know what you're thinking. If there's any other questions that you'd like me to answer, I'm always looking for suggestions. So thanks, guys. I'll see you later.